Hello everyone, I'm Rob Smith, that's Smith in the Black here, and as we continue to reach out to more and more traders, first question is always the same. What's the strat? So now we can just send them right here. So what is the strat? The strat is short for the strategy, and it's a strategy that I developed based on universal principles and price action to which all price must adhere. It's impossible for it not to. So what we want to do is eliminate any subjectivity when we're coming to look at price action. So once you see this, it's my sincere belief that all trading and investing will have to refer to the strat in the future. Definitely has to. So if we take a look at this, what is the strategy based on? Universal principles. What are they? Well, first, we're going to start with something I call the time frame continuity principle. So by using multiple time frame analysis, if you'll notice this is Tesla on the month, you'll notice that it's green, right? If you go to the week, you'll notice that it's green. If you go to the day, you'll notice that it's green. And if we go to the 60-minute, anytime this is green, we know what's going on, all right? So what I mean by that is that would be called full time frame continuity to the upside, right? So for every buyer, there's got to be a seller, right? Price doesn't move, it aggregates, right? You have to have a seller for every buyer. So when everything is green, this tells us that the buyers are more aggressive. They're taking the offer, right? By price, multiple time frames. On a monthly basis they are, on a weekly basis they are, on a daily basis they are, and on a 60-minute basis they are. Now that we know that 70% or more trading is done algorithmically these days, we can pick up on algorithmic activity, right? How do I know that? Because you have to tell a computer program 4 things. What do you want it to do? What symbol? In this case, Tesla, right? What do you want it to do, buy or sell? Buy. How do you want it to buy or sell? By staying on the bid or taking the offer? In this case, taking the offer. When do you want it to do it? Now, right? That's exactly what they told them when you have this condition. Tesla, buy, take the offer now. There's no other explanation. That has to be occurring. So even if it wasn't algorithmic and it's just people out there, there's still, the buyers are more aggressive, right? That's what that tells us. Very important to understand that price aggregates, it doesn't move, right? So when people say something has momentum, it's an analogy. It's not actually happening because momentum is mass times velocity. Price doesn't have mass, right? It aggregates. So you're watching the aggregation series of what the buyers and sellers are doing. Who's getting their price? Are they hitting the bid or are they taking the offer? Second, we call scenarios. So if we look at any chart, from one bar to the next, there's only 3 things that can possibly happen. Scenario 1, an inside bar down here, not strong enough to take out the previous bar's high or lows. That's consolidation. 2, scenario 2, takes out one side of the previous bar, here. And a scenario 3, you take out both sides of the previous range. Right? This is one of the most important things you can understand, that this phenomenon exists. On a shorter time frame, it would be a broadening formation. Right? So by moving time frames around, we can see that. But it's not important to understand that broadening formations exist. It's important to understand that taking out both sides of a previous range happens. Therefore, when you fail one side of a range and start coming back through, and you have full time frame continuity, we know that an outside bar is about to occur. Right? So once we can do that, that's the proper way to gauge magnitude. And finally, there's only so many ways price can continue or reverse. Okay, so what I mean by that, if you just know the major reversals, you're good. So because there can only be so many combinations of scenarios, right? So here's the way price reverses. You'll notice this here takes out the previous high. That's a 2 up, right? The next is a 2 down. That's a 2-2 reversal. It can happen to the upside or the downside, right? Okay. The next type of reversal is a 2 in one direction, followed by a 1, followed by a 2 in the other direction. It's called a 2-1-2 reversal. Third the outside bar itself. Failed 2 goes to the upside, turns into a 3, right? And if you just know that and you combine multiple time frame analysis with time frame continuity, you know exactly what's happening. So you'll notice here, the 2 down, the inside, the 2 up, the 2, the 2, the 2, the failed 2 goes 3, the inside 1, 2 to the upside. So when you look at these, what you'll see is either things will be lining up across multiple time frames, giving you continuations, which would be a 2-2 directional, right, or a reversal. And once you know that, there's no more guesswork. We know exactly what's happening. Most importantly, when you look at internals of the market will trade in the direction of the most 2s and failed 2s going 3 in the same direction. It has to. It's impossible not to, right? So once you know that, we can count that, and we have a statistical analysis of what's exactly happening. So when you have continuity, we know exactly what's happening, right? We know what reversals look like. You can see it all over the place here. The monthly SPY, down, 1, reversal. There was your 3 reversal, right, to start off the year, smash, right, all that kind of stuff. So that's just a brief introduction to what the strat is. All right, welcome to the strat.